Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, it may have been a crummy weather day, but it was a good day for the bond market here in the U.S. Well, actually, a lot of global bonds yields were down. So people were buying bonds, no doubt about that, on this crummy start to the week. And it is the Tuesday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless, of course, I take a month off for whatever reason. And I won't be doing it every day, but we are back. And the last time we talked was last week, right before the Fed meeting, and we'd had a couple good days in the bond market. And then after that, we had the Fed meeting. Fed was, bond market wasn't a huge fan of what Kevin Warsh had to say, not a huge fan of this sort of move away from forward guidance. And since then, bond rates have been on the move upward. And so it was nice to see a little pullback in the 10-year. 10-year was down almost 7 basis points. I think at one point it was almost 8. And then at one point it was like mid-5s, but kind of right around 7 basis points. Unfortunately, for the housing sector, is that Mortgage News Daily only had mortgage rates falling 1 basis point. So even though the 10-year, because it's always important to remember that while the 10-year and the 30-year do move kind of together, it's not identical moves. It's not like 10-year moves 2 basis points, 30-year moves 2 basis points. It's not how it works. They move in similar directions. And so sometimes you'll see a bigger jump in, or bigger move in mortgage rates. Sometimes you'll see a bigger move in interest rates or the 10-year yield. And today was one of those cases where you saw kind of a big move in the 10-year and not a huge move for the 30-year fixed, according to mortgage-backed securities. So something to keep in mind as we do see some positive news from the bond market. So what was causing that? Well, first, Iran, no doubt, as we've seen, I don't know how many weeks in a row this has happened, where we hear about a possible, President Trump will talk about more, doing more in Iran, bigger, where some of the more colorful language that he uses, and some of the bigger threats that he uses against Iran, usually makes those Friday after the markets close. And then by Sunday night, when the futures markets open, all of a sudden there's a deal. We're close to a deal. We're working on a deal. I'm going to pull back on these threats. And it's like Groundhog Day. And it's over and over again, right? And so we see, markets kind of puke heading into, the weekend. And then by Monday morning, things are looking up again. And that's what we saw today. Both equities and bonds were on the up and up. And it's funny because, usually, it used to be that equities and bonds moved different directions, right? Because people were selling bonds, buying equities. So bond prices would fall, yields would rise. And then they'd buy stocks, or they'd sell stocks and then they'd buy bonds. So bond prices would rise and yields would fall. And what we see now is basically the sort of buy America, sell America trade, where everyone's either buying everything American or selling it. So they're either buying stocks, bonds, whatever. And then when they sell everything as well. And so you're seeing bonds and stocks kind of move together. And so we don't really kind of know where things are. There's still a lot of uncertainty in the Middle East and exactly, what role our allies are going to play. Israel's still been kind of on the sidelines ever since the ceasefire really took hold. And then even after the ceasefire ended, we just haven't heard a lot from Israel, of course, our big ally in the beginning of this war. And so there's a lot of uncertainty. And we're 3 months away from a election, and we just got some pretty bad news for the GOP. There was a poll, Reuters Ipsos poll, for the first time since 2017, 2016, because it was 10 years, that Democrats are now trusted more on the economy than Republicans. I mean, it's not a huge number. It's like, what is it, 30? Let me get this right because it's kind of funny. 37% of people said Democrats were better versus 36% of people who picked Republicans. 27% and people don't really know. So not a huge difference and not like a overwhelming support, but a move into the positive, and that no doubt is going to play into decisions that Trump is going to make kind of moving forward. So that definitely played a part in the bond market, no doubt about that. But then the bigger news that we started hearing about on Sunday, well, actually, I guess end of last week, there was that note that Scott Bessent had written down about, buying yen. And then we found out exactly what that was going to entail on Sunday night, I think it was, where the U.S. and Japan confirmed a joint kind of intervention into the Japanese yen. So the U.S. and Japan jointly intervened in currency markets to prop up the Japanese yen after it sank to a fresh 40-year low, marking the first time a coordinated yen buying operation since 2011. Interestingly enough, in 2011, it was actually to stop the yen from appreciating after the earthquake and tsunami and everything. It was a concern about the yen appreciating. And last time in 98, there was something that happened in 98 where we stepped in to stop it from depreciating. So 2011 was actually about the yen appreciating, interestingly enough. A weak yen isn't just a Japanese problem. It has implications for U.S. manufacturing, inflation, and even mortgage rates. President Donald Trump said the U.S. was helping Japan as a sign of friendship. Treasury Secretary Scott Bessent also confirmed on Friday the intervention, saying Washington, quote, will not hesitate to participate in further joint intervention. So why does this matter? So for those who may not know this, a lot of times people are surprised by this. Japan is actually the largest foreign holder of U.S. debt. A lot of people still think it's China. China has been selling off U.S. debt. In fact, they now hold the lowest amount since I think the 90s. Japan, by far, top dog. I think it's 1.14 trillion. I think the UK is second with like 982 billion. And then China is somewhere under them and then, kind of falls off from there. So Japan owns a bunch of treasuries. And Japan is worried about its currency, its falling value. And so one of the ways, a country can deal with that is they can raise interest rates, which Japan doesn't want to do. They're actually keeping their interest rates artificially low. So the only two other things they can do is reduce the money supply, pull money out of the system, which won't be great for the economy, or they can buy yen on currency exchanges. Now, in order for Japan to get that money, they don't want to print more money, to buy yen, or they don't want to create more money, which would be bad which would cause even more the yen to lose even more money. And so one of the concerns is that what could happen is that they would sell U.S. Treasuries, get that yen and kind of hold on to it, or even use those dollars to buy yen, because remember, I'm losing myself here. So if you own something that's in a dollar denominated, it's a dollar denominated asset like a treasury, it's in dollars. So when you sell the treasury, you're then going to get dollars. Then they're going to turn around and take those dollars and use those dollars to buy yen and pull them off of the exchange, reduce the amount that are out there to prop up the currency. Well, we don't want that. We don't want them selling treasuries because we don't want the 10-year. We don't want U.S. debt. If they start selling off, they're the largest holder. So they start selling off those treasuries. One, they're not going to be buyers anymore. So we're going to make up for that. And then two, we need even more buyers to make up for the fact that they're now selling. That's going to put upward pressure on U.S. debt yield. We don't want that. So the U.S. has said, no, don't sell treasuries. We're going to help you out. we're going to buy some yen, and you're going to buy some yen, and that's going to help stabilize things. And that's pretty much what we're doing. So we are helping Japan. There's no doubt. But we're also helping ourselves because we don't want our interest rates going up. It's already wreaking havoc, of course, in the housing sector, which would be directly impacted by that, as well as just overall borrowing costs. We don't really want that right now when everyone's not really sure, right? We just got some GDP data last week that wasn't so hot. But we just also got a manufacturing report out on Monday that was phenomenal. So, everyone's still kind of questioning exactly where we are. But here's the problem. And this is Robin Brooks, who I've talked about many times on this podcast, has a great Substack. He's with, the Peterson Institute, Brookings Institute. And he's been arguing about Japan having a debt crisis for as long as I've been reading him. And he's constantly talking about this. A reminder, our GDP, which everyone's concerned about, rightfully so, our debt to GDP is like 101%. Japan's like 250%. And Brooks argues, they're keeping their interest rates artificially low because the Bank of Japan is buying their own debt. And the borrowing rates in Japan should be higher because they should be looked at as being a riskier economy with that possibility of default. And so when, you're worried about a country defaulting on its debt, or you're worried about, possible massive, or for, let's say Japan hits that debt crisis, the only thing you can do is basically print money. So you're looking at a potentially, hyperinflation. And so if you're going to lend money to Japan, you're going to buy Japan's debt, you're going to need higher interest rates. And Japan's keeping their rates low. And so the only way to sort of counter that as an investor would be, instead of buying bonds, I guess you're selling yen. You have no faith in the country. And so a lot of people out there are selling yen. They're getting out of yen. And that's causing yen to depreciate. And Brooks basically argues that it's mostly because what should be happening is interest rates in Japan should be rising, but the Bank of Japan is keeping them artificially low. So Brooks actually argues that he doesn't think this is going to work. He says, first, there's been 2 rounds of previous rounds of intervention this year alone. The infamous rate check by the New York Fed on January 23rd, ahead of the election in Japan. And then there was a huge intervention on April 29th that swapped anything seen previously. Neither of these efforts worked in the sense that the yen quickly resumed its weakening trend. News that the U.S. participation in this intervention but sold euros to buy yen is confusing markets and will prove counterproductive, Brooks writes, saying, as I laid out in a recent note, Japan sells U.S. Treasuries when it intervenes to prop up the yen, which can be a force for U.S. yields to go higher. Now, that's what the U.S. is hoping to counter by saying, well, we'll help you out. Please don't sell. But that could also have its own disastrous effect where it doesn't actually do anything to help, which Brooks doesn't really think is going to happen. So what the reaction from the market, I think, is twofold. One, it's what happened with Iran. And then also the fact that there was a concern with the yen depreciating that we could see the market flooded with treasuries, which is why you could have seen people selling treasuries. And then the U.S. stepping in, Japan now not having to sell treasuries, could bring people back to the marketplace and say, okay, I was worried about that. Now it's not going to happen. Hence the drop in yields. But if you believe Brooks, this could be short-lived. So we will see. But keep an eye on what is happening in Japan. It's one of the most kind of important things is while domestic news is usually the most important thing, sometimes global events can impact mortgage rates for the good and bad. For the good and the bad. All right, speaking of domestically, before we go, I don't want this to slip through the cracks because it really felt like it did. I didn't really see any reports on this. So beginning of the month, we always get a report from the Institute for Supply Management, the PMI report, looking at manufacturing. And holy crap, this report, by all accounts, was phenomenal. I mean, it really was. I mean, it was stellar report. So once again, the Institute for Supply Management manufacturing PMI jumped to 55.6 in July, up from 53.3 in June, and well above economists' expectations of 54. Now that rise, better than expected, was not only just better than expected, but it rose to the highest level that we have seen since May 2022. That is over 4 years ago. So manufacturing activity, highest level in 4 years. Now, not surprisingly, the employment index climbed to 52.8. That was a 3.1 point jump from June. And that was the highest reading in nearly 4 years. I think it was like the highest reading since August of 22. So not exactly 6 years, or 4 years, but close. So we got activity up and employment up. So what do you think happened to inflation? Now, of course, pure economics would say, well, inflation had to go up. Activity's rising, employment's rising, prices had to go up. Wrong. The price index remained in expansion territory, so it's still not in a great place at 71.1, but it was a 1.9 point drop from June, and now it's at the lowest level since February. So, I mean, that's like the best of everything. Activity up, employment up, prices down, or at least price growth slowing. That's phenomenal. I mean, you can't beat that report. The only real kind of non-event was the new orders index rose to 56.7, extending its expansion streak to 7 consecutive months. And kind of we're in this narrow range that we've been for like 4 or 5 months. But that's a phenomenal manufacturing report. And so with all that's going on in the world, Iran, Japan, everything, some good things happening here in the U.S. That's a stellar manufacturing report. I didn't want it to get lost in the shuffle. So some good things happening in manufacturing here in the United States. All right. That's it. We're done. We'll be back here tomorrow for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.